Welcome to Capital Link's corporate presentation webinar series. In this series, senior management of listed shipping companies provide an update on their operations, business development, strategy, and sector outlook. I'm Nicholas Bornoulis, president of Capital Link. Capital Link is an investor relations firm also active in event and conference organization. We work with several private and publicly listed shipping companies, including companies featured in this webinar series. As noted in our disclaimer, these presentations are purely for informational and educational purposes. They do not constitute investment advice or advice of any kind, and Capital Link bears no responsibility for them. Today, we kick off our series with Starbulk. We have with us the senior management of Starbulk. We have Mr. Hamish, Norton, president. We have Mr. Simos Spyrou, co-CFO, Mr. Christos Begleris, co-CFO, Mr. Constantinos Nanopoulos, deputy CFO, and Mr. Constantinos Simantiras, who is the deputy chief investment officer and head of market research. Our session today will be 45 minutes. We will start with the presentation, followed by a live Q&A session. Please submit your questions through the Q&A button at the bottom of your screen. Please include your name and company affiliation when you submit a question. Alternatively, you can email your questions to us at webinars@capitallink.com. Again, thank you very much to all of you for joining, and I'm turning it over to Mr. Hamish Norton.
Hi, good morning. Now we have a brief corporate presentation we'd like to go through. Eleni, if you can put that up on the screen, thank you very much. And let's flip to the first slide with text. Yeah, so that's our forward-looking statement disclosure. You can read that at your leisure. It's on our website. Next slide. Okay, so key investment highlights for Star. We're the largest, most liquid US listed dry bulk company. We have a fleet of 128 high quality vessels with an average age of about 9.9 years. We have very significant leverage to strong dry bulk market fundamentals. Basically, we've got 46,000 ownership days, a little more than that, which means that every $1,000 a day is another $47 million to our bottom line. Today, we've got a very strong balance sheet that supports our very important dividend policy. We've got total cash as of the end of the year of $474 million with a very limited CapEx requirement. We've reduced debt 35% in the last 2 years. And in the last 12 months, we've paid out $2.25 per share in dividends through a very transparent, if slightly complex, dividend policy. We're highly levered, as I said, to strong market tailwinds. The industry has the best supply side dynamics in decades with very slow fleet growth and the anticipated impact of environmental regulations on that fleet. The current rates are sustained by port congestion, fleet inefficiencies, and quite rapidly recovering demand. And GDP forecasts imply continued demand for seaborne dry bulk trade. And also, I want to point out that 120 of our 128 ships have exhaust gas cleaning systems called scrubbers that allow us to use substantially less expensive high sulfur fuel and save a lot of money. Eleni, if you could go to the next slide. So as I've said, we've got the largest fleet in the industry with significant operating leverage, 128 vessels. It's a diverse fleet, which means we've got exposure to all cargo types and trade routes. And it's, as this slide says, 46,700 ownership days in 2022, split up, as you can see at the bottom, by deadweight. by deadweight, a small majority of our ships are Newcastlemax and Capesize. Next comes Panamax and Kamsarmax, and then Ultramax. The number of ships in each category is much more close to equal than the deadweight weighted breakdown would indicate. So it really is a fully diversified fleet. Next slide, Eleni. So, what this slide shows is our market cap in the dark line and average volume in the gray shading, and then it shows each of the transactions where we've been able to use our share to acquire ships in a way that increased our market cap, increased our liquidity, increased our public float, and these were companies that wanted our share at net asset value. This is almost half of our fleet was acquired this way. It was 58 ships since the beginning of 2019. And that included a Norwegian company, a German company, an Italian company, an American company. It's really unheard of from for a Greek-based shipping company. It's the first time this has been done. Next slide, Eleni. So why don't I let Simos Spyrou, our co-chief financial officer, take this slide?
Thank you, Hamish. This slide shows our focus on operational excellence. We operate a fleet with one of the lowest average daily operating expenses among our peers, without at the same time compromising on quality. For the first 9 months of 2021, our operating expenses were at $4,282 per day per vessel, running number one with the lowest cost among any of our peers. Net cash G&A expenses per vessel per day were slightly above $1,000 per day per vessel for the same period. At the same time, we are consistently in the top 5 dry bulk operators amongst our peer group in the RightShip ratings, and you can see both the cost on the bottom side of the graph, left bottom side of the graph, and the RightShip ranking for the end September 2021 period in this slide. Eleni, if you can move to the next slide.
And why don't you take that as well?
Okay, this is basically showing our improvement of the balance sheet, of our balance sheet during the last 2 years. We have a very healthy liquidity and competitive financing. Our cash balance, as Hamish said earlier, at the end of December 2021 was at $474 million, and our total debt and lease obligations at $1.56 billion. We had a working capital of $80 million as of Q3 2021, and an annual amortization profile for our debt of slightly above $200 million per annum. We have currently 5 debt-free vessels, and we have 0 debt maturities until the end of the third quarter of 2023. On the recent development side, we have paid $2.25 per share in dividends over the last 12 months. We have completed 4 refinancings, which raised approximately $400 million in senior debt, and it resulted in interest savings of approximately $5 million per annum. Our pro forma average margin stands at about 2.4% for our entire debt. On the bottom side of the graph, you can see clearly how our net debt, adjusted for the latest acquisitions has been reduced by approximately 35% during the last 2 years, while our cash and liquidity on the same time has increased by approximately 277%. Eleni, moving to the next slide.
Yes. Yeah, why don't you take that also?
Okay, basically on this slide we are showing our minimal capex requirements for 2022. We have on the graph the dry docks, the ballast water treatment installations, and the energy saving devices that we have agreed to install during the year. Although the dry docks are not capitalized, actually they are expensed, but we are showing here that we have 12.3 million of dry docks for Q1, 6.3 for Q2, 4.5 for Q3, and 3.1 million for Q4. The ballast water treatment and the energy saving devices are capitalized at their actual capex. We have 8.7 million for the first quarter, 0.4 million of energy saving devices, and then respectively for the second quarter, 3.8 million of ballast water treatments, 1.8 million of energy saving devices, and then figures are minimal for Q3 and Q4. And we have also here at the bottom a budget, actually the approximation of off-hire days for the installation and of the ballast water treatments and the dry docks for the year. We estimate 340 days of off-hires for the first quarter, 176 days of hires for the second quarter, 129 for the third quarter, and slightly below 100 days for the fourth quarter.
Okay. So so our dividend policy is very transparent. It's a bit complex. It's getting simpler. So basically for Q3, we've given an example. We had a total cash balance at the end of the quarter of 371.7 million. We had a minimum cash balance per vessel at the end of the third quarter of 1.9 million per vessel, which you can see is part of our policy on the right. We had 128 vessels, so 128 times 1.9 is 243.2. Subtract 243.2 from 371.7, you get a declared dividend of 128.5 million. Number of shares 102.288, works out to a dividend per share of $1.25. And you know, our dividend policy has switched to the next bucket of minimum cash per vessel, 2.1 million for Q4 and thereafter. And you know, we have announced that we have 474 million of cash on the balance sheet for December 31. So that calculation is fairly straightforward to make. We're not going to make it for you because that's you know, the board's prerogative, but I think you've got the data to make that calculation for yourself. Eleni, next slide. So operating leverage and cash flow potential. So basically, if you look at our daily time charter equivalent rate, you can project that for any given quarter. And we've made a box around the one at 23,500 per day. We've calculated based on our break even that would result in 4.9 million of free cash flow per share. And the free cash flow yield, you know, would be 22% of today's share price. And, you know, that's basically the dividend yield at today's share price with that charter rate. on a quarterly basis. And you can see that at 31,000 a day charter rate across the fleet, it's not quite double that at 37% cash flow yield, and $8.2 of free cash flow per share. But even at 16,000 a day, it's pretty respectable at a 7% free cash flow yield on the share. Next slide, please. So we are very active trying to lead the way, setting standards for the industry. We've joined the Maritime Anti-Corruption Network, which you can read about there. We've participated in drafting the Poseidon Principles for Marine Insurance, which is an initiative by the Global Maritime Forum to basically align the insurance portfolios with responsible environmental impact. We're a member of the Getting to Zero Coalition. We're a signatory of the call to action for shipping decarbonization, and we're actively participating in sponsoring the Next Wave Green Corridors report. And we're looking at being one of the leaders in zero carbon shipping. And we'll have more to report on that hopefully soon. Next slide. So again, this is on greenhouse gas issues and other ESG reporting. We publish an annual ESG report, which discloses our carbon footprint and the carbon intensity of our fleet. We share the carbon intensity data of our fleet with our stakeholders through the Poseidon Principles and the Sea Cargo Charter. We participate in the Carbon Disclosure Project. We have sustainable linked loan facilities where we have specific commitments to comply with carbon intensity targets. We employ telemetry across our fleet, which allows us to accurately monitor in real time the energy efficiency and the CO2 emissions of our vessels. We employ a dedicated in-house R&D team to examine new technologies, and we pilot new software and hardware technologies to optimize our voyages, optimize our carbon emissions. It's something we take extremely seriously. Our CEO takes it seriously. I take it very seriously. We spend a lot of time on this. And you're welcome to download our third ESG report. Yes, Eleni, in the next slide. So with this market overview, let me have Constantinos Simantiras, who's our head of market research, among other things, take us through the market section.
Thank you, Hamish. For the market overview, I'll start with the three graphs on the right, where you can see that during 2021, there was a very strong increase among all three key sectors, dry bulk sectors, with freight rates for Capes averaging 33,000, Panamax 25,000, and Supramax at 26,000 for the full year. These are levels that we haven't seen for more than a decade and are extremely profitable. Looking into 2022 and 2023, fundamentals fleet growth is set to decrease significantly, while demand for dry bulk commodity is expected to continue to grow at a healthy pace. The IMF forecast global GDP to grow by 4.9% in 2022, while Clarksons expects healthy demand across all dry bulk commodity groups and resulting up to approximately 2.2% growth after factoring in also longer distances. So it's in ton miles terms. Finally, the strength that we're seeing in the container markets should continue to support minor bulks and dry bulk volumes through Cascade. at least for the next couple of years, 1 to 2 years. Then focusing on the supply side, as Hamish mentioned in the beginning, we have the most favorable supply dynamic in almost 3 decades. There are new emission regulations and uncertainty on future vessel propulsion technology that is keeping new ordering under control. The order book stands at 25-year lows, and fleet growth over the next 2 years is bound to correct to record low levels, probably below 2%. And finally, there are trade inefficiencies and increasing bunker costs that are expected to continue to further reduce effective fleet capacity. Let's move to the next slide. Here we have the 4 key categories. We expect a healthy demand growth across all commodity groups, despite the impact of new COVID variants and the repeated downward revisions of GDP growth forecast during the last year. We highlight here that over the last decade, iron ore ton miles have grown by 3.3% per annum, coal trade by 2.6% per annum, grain trade by 5.1% per annum, and minor bulks by 3.5% per annum. Focusing on the short to medium term, we believe we're still at the early stages of the global reopening from COVID, and restocking of all dry bulk commodities will support import growth over the next 2 years. Furthermore, we believe that increased exports from the Atlantic will have a very beneficial effect on ton miles and will further enhance inefficiencies. Next slide. Here is a simple slide highlighting how that the order book is at 25-year lows. Over the last 1 year, it has stayed at 7%, approximately 7%. It's worth showing where the order book was in 2008, 2009, when it almost reached 80% of the fleet on the water. Next slide, please. Here we highlight that despite the very strong freight market that we mentioned 2 slides ago, that during 2021, ordering has been kept under control. Due to several factors. One of these factors is that the uncertainty related to future propulsion and the upcoming environmental regulations. This is something that makes the supply picture extremely bullish for the next few years. Let's please move to the next slide. And this is the result of the low order book and low ordering. As you will see, fleet growth over the next 2 years and into 2023 experienced a sharp decline, and we should drop below 2%, and that's with assumptions of a relatively low to non-existent scrapping. Next slide, please. Furthermore, the effective fleet capacity may be further reduced as a large portion of the fleet is non-fuel efficient, and the only way to decrease fuel consumption and emission without incurring capex is to reduce sailing speeds. We'll highlight that approximately 60 to 65% of the fleet is non-eco and not fuel efficient. And on the bottom graph, we show the evolution of steaming speed over the last 1.5 years, and would highlight that for every 1 knot decrease in speed, that would result in a decrease of effective supply of approximately 6%. Let's move to the next slide, please. And here we would like to highlight that as fuel prices and spreads increase, owners of inefficient vessels will be compelled to decrease sailing speeds, and vessels equipped with scrubbers will deliver superior economic performance. On the top graph, I would like to highlight that the fuel spread between HSFO and VLSFO at the end of 2019 was at $300 at the beginning, before the IMO 2020 regulation came into effect. Then COVID happened, spreads and oil prices collapsed, The spread went down to $50. This has moved higher. Today we are at levels close to $200. And it's interesting to highlight that SBLK has been able to date to generate 200 million of scrubber savings, and on the basis of the current forward curve and our estimated annual consumption on bunker fuels, we should generate approximately 94 million of scrubber savings every year. And for every $20 per ton increase in the spread, this would add and would generate additional savings of 40 million per annum. And with that, we conclude our presentation and we can move to the Q&A.
Yes, and we've got some questions. So one question that came in: if you were inclined to purchase vessels in the secondary market, what class and size of vessels would you prefer? And, you know, the answer to that is we really like our fleet composition. It's diversified in what we think is just about the ideal way, giving us access to pretty much all of the dry bulk cargoes in the industry. And, you know, if we could acquire a fleet just like ours for shares issued at NAV, especially given that we're trading at a small discount to NAV, we would jump at the chance to do it. We probably would not be acquiring vessels for cash, but if we could do it for shares, if we could acquire our existing fleet, you know, a sister company, we would jump at the chance. Next question I see is, how do you expect new environmental regulations to affect shipping in the years to come? It's going to be a very positive effect, we think. Basically, couple of things. One is that for 2030, you want a ship that is either a very low carbon ship or a zero carbon ship by design. And you can't buy that ship today. In 2 years, maybe you'll be able to order such a ship. But, you know, what this is doing is it's suppressing new building orders, because people know that they can't get the technology that they want in a new building ship yet. And the other thing is, with the older ships, as Constantinos Simantiras said, it's going to make them go slower, because going slow is the way to save fuel. You know, you go a little bit slower, you burn a lot less fuel. But of course, if you're going slow to meet the environmental regulations, that means that the carrying capacity of the fleet is reduced. And that means basically that charter rates go up. So we think it's going to cause charter rates to go up. We think it's going to keep new buildings down. You know, we are all in favor of more environmental regulations, more stringent environmental regulations. We think it's also going to favor large companies who have the ability to pay for the costs of compliance. And of course, we are, you know, just about the largest dry bulk company. So it should favor us and not so much our smaller peers. What are our capital allocation priorities going forwards? Our main priorities for the time being are to pay down debt and to pay dividends. And that is what we are doing. We are paying down our debt. We are not taking on additional debt at the moment. And we are paying, you know, very substantial dividends. And, you know, I would expect that the dividend we declare for the fourth quarter will be right in line with what people expect in terms of large dividends. We are not intending to buy ships at the moment for cash. Although, as I said, if we can buy fleets with our shares, we would jump to do that. You know, what differentiates SBLK from its peers? You know, we have some fine peers. So given that, why should investors buy our shares? Well, first of all, we have the largest market cap and liquidity. which can be very important if you want to assemble a big block. We have excellent chartering results. 120 of our 128 ships have scrubbers, which add significantly to our time charter revenue, as Constantinos Simantiras pointed out. We have the lowest operating expense per vessel per day among our peers. We have the lowest overhead per vessel per day, leading to just about the lowest cash flow break-even per vessel per day, while being ranked first among peers in industry safety rankings. You know, other dry bulk companies are proposing to pay dividends, but we believe that our dividends will be greater. We have over 46,000 ownership days in 2022. So for every 1,000 a day of time charter equivalent revenue per ship over our all-in break even of about 11,000 per day, we earn an extra $46.7 million. And what will keep time charter rates high? More regulation and more decarbonization. We're the largest listed dry bulk company in the US. So the more regulations, the tougher the regulations, the more difficult, therefore, the regulations are to comply with, and therefore the bigger our advantage as a large company. Most dry bulk companies don't have the size needed to be able to afford all the regulatory compliance functions that we think will become increasingly necessary. And, you know, we're looking at you know, piloting zero carbon ships as soon as we can. Let's see, could we expect a super cycle from 2023 to 2030 due to all the known variables of the order book, to fleet EEXI, CII, and design of vessel uncertainty? So Constantinos Simantiras, you want to take the super cycle question?
Okay, so that's definitely a difficult question. We are extremely optimistic for the next decade. If we compare it to the early 2000s, back then we had a demand-driven super cycle. We do believe that this decade we might see a supply-driven strong cycle. I don't want to name it a super cycle, but we will have huge renewal needs for the fleet, and we don't think that the capacity, the shipyard capacity, is there. We need to highlight that the boom that's happening on container ship is taking a lot of shipyard capacity. Demand will continue to expand, so we are very optimistic for the next several years.
Okay, and then another question. What is your outlook for iron ore and coal shipments? Any concern about China growth? What impact would an export ban of Indonesian coal have on the market? Recent rate volatility, is that normal seasonality?
Okay,
I think
that's 4 questions actually. Well, iron ore and coal shipments, our outlook for 2022 is very positive. Obviously, in the short term, there are headwinds. There is the Indonesian ban that has affected the coal exports from Indonesia. However, this has been already been lifted, and we expect that by February we'll see a return of full volumes. At the same time, we had rains affecting Brazil iron ore during the last few days, and this has affected the operations. Again, this is short-term negative, but at the same time should inflate the rest of the year, and this makes us extremely positive. Generally, we are now, the market balance right now is quite good, especially for the smaller sizes. If you look at the rates for what is normally a weak period in terms of seasonality. I think that demand, it's important to highlight that although we had China experiencing a strong slowdown during the second half of last year, demand from the rest of the world made up a lot of it, this shortfall. And we expect that China will ramp up demand after the Chinese New Year and Winter Olympics, and we are extremely confident on that.
Okay, so then we've got two questions more or less identical on whether we expect slow steaming if oil prices continue to rise. Shouldn't it effectively reduce capacity and thus provide a floor to rates, i.e. higher lows? And the answer is yes. We do expect that with higher oil prices, unless charter rates go up, that there will be slower movement of the fleet and reduction of fleet capacity. Basically, the profit maximizing speed is inversely proportional to the cube root of the oil price. So if the oil price doubles, you know, your speed is divided by the cube root of 2. So yes, what actually seems to happen is that charter rates go up when oil prices rise in order to keep the movement of cargoes going. But I mean, that's just as good, right? That makes everybody just as happy, unless they're cargo owners. Your fleet seems weighted towards larger vessels is the next question, or focused on the major bulks. Any thought on expanding exposure to minor bulk market? You know, it's not as focused on the larger vessels as you might think. If you look at it weighted by deadweight tonnage, yes, it's, you know, majority Cape and Newcastlemax. But, you know, if you look at it ship by ship, it's actually majority Supramax, Ultramax, and Kamsarmax by a fair margin. And so, frankly, recently, we've been getting a majority of our revenue from non-Cape ships. And, you know, we've been getting a lot of revenue from minor bulk. So it's actually more diversified than you might think. And here is a question, I think, for Constantinos Simantiras. Thoughts on new building prices today, as well as steel and labor costs impact on new building prices?
Well, thoughts. Well, definitely new building costs over the last 2 years have increased substantially, especially steel prices. This has trim into profit margins of shipyards, and in a way provides downward downside protection. So yeah, we are in an inflationary environment, and this is likely to support dry bulk asset values, and especially of modern eco fuel efficient tonnage. We should also highlight that the shipyards are focusing on other types of vessels, like containers that are significantly more profitable. So this is something that we find very positive for the asset value environment.
Okay, so then we get a question. How is Star Bulk looking to employ future cash flow? Are dividends more of a priority today than strengthening the balance sheet? And the answer to that question is we are doing both. And, you know, obviously they're somewhat in conflict, but, you know, we're paying down well over $200 million of debt per year. Simos Spyrou, what's the more exact figure of debt we're paying down per year?
207. Okay,
yeah, good. So it's 207 of debt pay down per year. And basically the rest is going to dividends. So, you know, we're trying to set a balance. Our balance sheet is already pretty strong. Let's see. Scrubbers are a defensive technology shielding a fuel falling out of favor and is an economic, not an environmental greenhouse gas reduction. Given the ever tighter CO2 regulations, are not both scrubber and non-scrubber vessels slowing to reduce fuel, thus lower carbon? Please comment. Okay, so yes, scrubbers are very helpful in removing sulfur from the exhaust gas stream. And in fact, if scrubbers had not been available in January of 2020, it would have been impossible to provide enough low sulfur fuel at the beginning of 2020 to fuel the entire fleet of the world's shipping and meet demand. You know, at the moment, what the scrubbers are doing is obviously, as you point out, giving us a big economic advantage. They don't address CO2 one way or the other. CO2 is addressed through slower speeds, through better paint. You know, hull fouling is among the most important things that a shipping company can do to reduce its carbon emissions. The more hull fouling you've got, the more fuel you burn, and it's shocking how much more fuel you can burn if your hull is fouled. So paints are very important. Hull cleaning robots are very important. We're looking at something called ultrasonic anti-fouling, which is a technology that may keep fouling from occurring in the first place. We are measuring the performance of our ships very carefully with sensors and very sophisticated computer programs incorporating artificial intelligence as well as naval architecture type calculations. And we're using that measured ship performance to optimize our route and the speeds over that route based on the ship performance and the weather and the currents that the ship encounters. And you know, just to give you an idea, keeping your hull clean can save you 40% of your fuel. It's just astonishing how much you can save by keeping your hull clean. And if you then optimize the route and speed, you can save another 10%. So, you know, it's a big deal, and we're devoting a lot of time and resources to that. Starbulk trades at a discount to NAV. How much do you have remaining in your buyback program? We have $40 million roughly remaining in our authorized buyback program. And, you know, if we see good opportunities to sell a couple of ships at a good price and use the proceeds to buy back stock, in effect, substantially cheaper, and take that arbitrage, we will do it. So why would a growth or value investor consider Starbulk versus other industries, including crypto or the S&P? I would say that a growth investor, you know, growth. Shipping is not what you would typically consider a growth industry. It's growing with the world economy, not growing much faster. But, you know, if you're a value investor, my God, you know, crypto and the S&P are pretty frightening if you're a value investor. And, you know, shipping looks like a pretty good value play to us at the moment. We are, after all, trading, you know, below the liquidation value. I mean, and, you know, with all of the advantages we provide relative to a bare hull, you know, we think that's crazy. So any updates for Constantinos Simantiras on Brazilian flooding and impacts to iron ore exports?
Well, there is no major update on the numbers, so this is relatively new. We'll probably have more details over the next few days. It's definitely not something similar to what happened a couple of years ago.
Yeah. So do you see consolidation in the sector with smaller companies being acquired? You know, as you can see from our presentation, we've done, I think, most of the consolidation that's happened in the dry bulk industry, and it accounts for about half of our fleet. So we're good at it. That being said, it's really difficult. it's these deals, we see many more possibilities than we end up closing. And in a better market, you would think it would become easier to do, but of course the sellers have higher expectations, and so that adds to the challenge. Hard to say.
Can I add one
Sure.
more thing before, because I see Nicholas has joined, so we're probably at the 45-minute mark.
Yeah.
And I saw some of the question. I think it's also important to highlight that although the market has corrected the last few weeks, especially on the larger sizes, that SBLK has been proactive on its chartering strategy. And as every year, we have tried to cover a significant percentage of Q1, just as a closing remark.
So, Nicholas, have we hit our limit?
Regrettably, we have. I mean, this has been a great presentation and a particularly interesting discussion. You have so many questions submitted, but we are at the limit. So maybe if you would like to give a very brief closing remark, I would be grateful if we can.
Well, look, I mean, we're very high on the prospects of SBLK, as you can see. We hope you are too.
Well, I'd like to thank all of you for participating. It has been a great session, and this will be also available as an archive for anyone who would like to come back and listen to it in more detail. Again, thank you to the SBLK team for joining, and thank you, of course, to the participants who made it such a great success. Thank you very much.
Thank you.
Thank you. Bye-bye.